What's up, guys? Norman Baker, Will Wealth Advisor. So let's talk about stocks today. When we talk about investing, when I talk about investing to you guys, we talk a lot about rates of returns in the stock market, why it's important to be involved in the stock market, particularly for our community, because we haven't been, right? We've been doing real estate, we've been saving, we haven't been saving really, but we need to start saving more. But when we do save, it's in savings accounts. Maybe some folks will use some CDs and things like that, but maybe some money markets, but we're not using this financial wealth building engine called the stock market that we have in the United States um, as our counterparts do. So a lot of times we fall behind from a wealth gap perspective. Two reasons we fall behind: one is home ownership, the other is participation in the stock market. So when we look at the stock market, one of the things that I hear is, well, really, what is it? Like, what are you investing in? What are you doing? What is it? Why is it important? I see stuff in the news about it's crashing and the sky's falling. Like, what's really going on? So we haven't been taught, right? Our counterparts, they're historically, their grandparents and great grandparents, and they've been investing in these things, right? But it really hasn't hit our community yet that we're really, really funneling capital there to drive wealth in our community. So, what I wanted to do is I wanted to try to break down a lot of the complexity about just what is a stock, right? What is it? What are we talking about when we talk about a stock, and then next, and I'm going to break these down in different videos because I don't want it to get too dense. But the next will be, well, what is the stock market, right? So I know what a stock is now. How does it relate to a stock market, right? And then the last video is, so now what do we do, right? The action item. How do we invest in this engine we call the stock market? So one thing to preface these three videos with: the information that I'm giving in the first two are for information only. We are not investing based on the information I'm giving. I want to explain so that we have a better understanding of what this whole thing as a stock market is. When we talk about how we're going to invest, it has nothing to do with it. We're going to look at historical trends and we're going to look at track record when we talk about investing, not these kind of details that really don't matter. But I just want to give them to you. So stop. Let's hit this quickly. So this kind of three, I'm going to walk us through this as an example with you and I. So let's say you and I own a pizza restaurant. We make pizzas. It's going to be called Norm's Pizzas. Let's say I'm the owner of it, right? We work together, but I own 51%. Let's say we own 50-50, but we'll call it Norm's Pizzas. So Norm's Pizzas, we have a company. All right, we've been selling pizzas, but now we want to make the company legit and we want to make it a corporation. So we go to an accountant. We got a buddy that's an accountant. Say, hey, we need you to create a company for us. He's going to give us a piece of paper for a C corporation, let's say. He's going to give us a sheet of paper. It's only one sheet of paper. It's going to say name at the top. We're going to put Norman Baker and your name. Then it'll be our address. And then it'll be the address we're doing business under. And then under there, it's going to say, how many shares do you want? You're going to say, what do you mean, shares? And the accountant's going to say, well, shares, it's how your company is broken out. Every corporation needs shares, right? You can say 100 shares if you want. So we're going to say, all right, accountant, we trust you, 100 shares. What does that mean? If you took a pie and you cut it into 100 slices, each one of those slices is 1/100th of the pie. That's all a stock share is. A piece of a corporation. That's it. It's a piece of a corporation. So in Norm's Pizzas, we'll have 100 shares or pieces of our corporation. That's what a stock is, period. Now, how does that relate to the U.S. stock exchange? So big companies do the same thing. So Apple or Microsoft or GE or ExxonMobil, all these companies did the same thing, but they probably did it twice. So the first time when they were small, they did what you and I were talking about. Norm's Pizza, Apple started in a garage in California. They probably did it this way. They went to an accountant, said, hey, we want to start a company. I'm Steve Jobs. You're Wozniak. We own 50-50, 100 shares. You have 50 shares. I have 50 shares. We own the company, right? But then as their business starts to grow and grow and grow and grow, and they want to attract investors One way to do it, especially if your business is really profitable and a lot of people are excited about it, one way to do it is through a IPO, initial public offering. All that means is that Norm's Pizza, this is what big larger corporations do. Norm's Pizza, when we get large enough, we're instead of going to go to our friend the accountant, we're going to go to an investment bank, Morgan Stanley, Goldman Sachs, those kind of guys, and we're going to say the old Bear Stearns before they went out of business, right? So we're going to say, hey, Goldman Sachs, we want to do an IPO. We want to sell our shares. I've got 50, and my partner has 50. We want to sell our shares to the public and bring them in as investors because we want to bring in money to our company. Right? You think about it. If I have 50 shares, you have 50 shares, we own the company, and we sell our shares to another guy, they're going to give us money for our shares. They're bringing in money to us, and we can then use that money for the company. So we tell Goldman Sachs, we want to invest in these shares. We want to sell our shares to the public. So Goldman Sachs is going to say, great. How many shares do you have? We're going to say 100 shares. They're going to say, great. I'm not going to do anything with 100 shares. What I'm going to do is I'm going to take your 100 shares, and I'm going to cut your company into 100 million shares. Okay, big difference. Now that pie we were talking about, cut into 100 pieces, now it's cut into 100 million pieces. Okay, and then Goldman Sachs is going to go through analysis and put some feelers out to the other investors they have in the business or in the financial community to see if they want to invest in Norm's Pizzas, and they're gonna come up with a price for our 100 million shares. Okay, and again, this happens with larger companies when your sales are really starting to grow, or you have potential for your sales to really grow. So let's say that they come up with a price of $10, and they say, Norm, because you're one of the owners of the company, of the 100 million shares, you're going to keep 40 million at $10. No, not 40 million. Let's say 20 million, and then my partner would keep 20 million at $100. 20 million shares at not $100, $10. 20 million shares at $10, 200 million. So I just made 200 million bucks on doing an IPO. This is what happens. This is how people become billionaires and millionaires overnight. Mark Zuckerberg kind of thing, right? So we do this IPO, and then Goldman Sachs pushes the shares into the U.S. stock exchange. So now folks are buying and selling Norm's Pizza shares. That's how a stock is created. Okay, so now if you went on online website where you can find stock prices, finance.yahoo.com is one of them. If you go to that website, at the top bar, it'll say search ticker or company. You type in Norm's Pizza, and my summary page will come up, and it'll say Norm's Pizza, $10 a share. It's trading. You can buy it. So that's how a share is created. Now, going from a share being created to a stock price. Let's talk about a stock price. Now, a stock price is composed of two components mathematically. One is called earnings per share, acronym EPS. The other is called price to earnings multiple, PE multiple, or PE ratio, you'll hear. Earnings per share is easier to understand, so let's talk about that first. Earnings per share. So at Norm's Pizza, let's say when we started, we went to our accountant friend and created a company with 100 shares. Let's say in that year, we sold 100 pizzas for $10. $1,000 we got in sales for that year. Let's say in that year, I paid myself $200. Let's say my partner, you, paid yourself $200. And let's say, so that's $400 in salary expenses. And let's say all other expenses, the pizza ovens, the car gas, the cheese, the dough, the meat, the vegetables. Let's say all that was $500 in that year. So $500 in expenses, $400 in salary. That's $900 in total expenses. Our sales were $1,000. Sales minus expenses equals earnings, simply put. So $1,000 in sales, $900 in expenses, $100 in earnings. Remember, when we talked to our friend the accountant, we created 100 shares in our company. To do earnings per share, you do earnings divided by shares. $100 in earnings, $900 in expense or in sales, minus $1,000 in sales minus $900 in expenses, $100 in earnings, divided by 100 shares. You get $1 per share. So our earnings per share would have been $1 per share. Okay, so that's how earnings per share is calculated. Now, the formula for stock price is earnings per share multiplied by PE ratio. PE ratio is a little more abstract and a little more complex. So PE ratio is price to earnings multiple. So it's kind of a back and forth, right? The PE ratio is determined on the price. So in a PE ratio would be, as an example, if in our example, Norm's Pizza went on the stock market and was sold for $10 a share. And let's say that the earnings were still $1 per share. Let's just say, as an example, the PE ratio would be price $10 divided by $1 earnings per share would be a 10, right? So our PE ratio is 10. Our price is 10. The equation for price is earnings per share 1 multiplied by PE ratio of 10 equals price of 10. So a PE ratio is kind of, it's driven off price. Now, the PE ratio is where a lot of the demystifying needs to happen on the stock market, because it's based on the feel, the sentiment of the stock market. And in the next video, we're going to get into what is the stock market? Who are we talking about when we're talking about the stock market? But for now, let's just use that term, stock market. It's the feel. It's how the stock market feels about Norm's Pizza, how the stock market feels about the pizza industry, how the stock market feels about interest rates, how the stock market feels about the president, how the stock market feels about the commodities that create the ingredients for pizza, how the stock market feels about the rest of the world, right? Because we'll get into the next video. The stock market is driven by people. The stock market is people. That's what it is, but we'll talk about it later. So the PE ratio is feel. Now, anytime somebody explains something or gives a definition of something and they use the word feel, what does that mean? That means it's not concrete. It's not math. It's abstract. It's feel. And this is where that demystifying comes from. So let me put it plainly. It is feel, right? There is a level of emotion in why these price fluctuations happen all the time. So you'll see on the news, oh, price went up, price went down. When the president election happened, it always happens. Right before the election, price is down. Then once we see who gets elected, price may go up or price may go down. Nothing's happening with the companies. It's the feel, the emotion, the fear or confidence of the people trading the stocks of what we call the stock market. So we've got to get comfortable with, and we will in the third video, or at the end of the second video, in the third video, we're going to talk about why we can get comfortable with part of a stock price being emotionally driven, right? Because that's what makes people uncomfortable. How can you invest in something if it's emotionally driven? Which it is. I mean, it's a fact, it is. And we're going to get into the next video of the stock market to understand why we can do that. But in terms of this video, stock price is earnings per share, which we calculated, showed you how to calculate, multiplied by a PE ratio. It gets us the stock price. So that's what a stock is. That's how it's created, and that's how the price is derived. Okay. In the next video, we're going to talk about the stock market and the details on that. Okay. WillWealthAdvisors.com. Email me if you got questions or if we want to work together, and get with you on the next video. Peace.